Paul Hickey's here. He's the co-founder of Bespoke Investment Group. He's at the table.
Wow, what a welcome.
I'm just saying, it's one way to start the year to say, hey, it could be good, but actually we got some things that we're really concerned about. Well, what are the things on your list?
I mean, I think, we're optimistic about the market still, but you also have to be realistic. We've had 2 really big years of gains, and when you look historically, you look at periods when a bull market reaches its second year. Historically, they last about 5 years, but that third year tends to be weaker than average. Okay, so you have that. We were talking about on Christmas Eve how the S&P was above its 200-day moving average every day last year. That's only happened a few other times. Average returns were about half. The next year were half the historical average. And then we had over 50 new highs last year, and prior years, 6 other years, 4 years, we were down the next year. So those are just things to be aware of. But overall, the factors of AI, I think what's going on in Washington and the broadening economy are still positive. It's just, I don't think we're going to see another 20% year.
The only thing that it makes me have pause with that, because I understand all the arguments, just where we are at valuations and things along those lines, is that everybody seems to be thinking the same thing right now, that we can't possibly have another year less.
Right, and that's a really good point, because everybody was talking about how the first few days of this year were going to be weak because people were sitting on gains. We're up 1.5%. And so historically, that's been a relatively good omen for the market going forward. But I think you got to have some balance here. And I think when it comes to Washington, it's really interesting when you look at what's going on, because all we hear about is uncertainty this, uncertainty that. How are we going to navigate? Well, there's always uncertainty in the markets. I think we're all aware of that. But I think in the last several weeks of the year, people started to underestimate the potential positives of the new administration. And what you saw is when the continuing resolution was passed, and you saw Mike Johnson get reelected as Speaker on the first ballot. The market, 2 of the best days since the election were those 2 days. And I think that's telling us that maybe the market's underestimating what can get done going forward, and as far as the less of the regulatory burden and lower taxes. And I think that could be a positive surprise going forward in the year ahead here.
Are you still but you're still in the double digit at the end of this year? We're up. Or no?
No.
You're saying not double digit.
I think we'll be up, but I just don't think it's going to be a year like we've seen the last 2. I wouldn't be surprised if we were down 5% or up 5%. Nothing would surprise me these days. But I think the alternatives to the stock market are weaker, I think. So
that's the question.
We're still staying invested, but just reining in our expectations.
But are you fully invested, or would you say you're waiting for something, something to happen, so you try to keep cash on the sideline because you think that there's going to be some moment, or that's not where we are anymore?
No. So what we're doing is we're still invested in our positions. We haven't necessarily been raising a lot of cash, but we're starting to diversify more from the growth orientated sectors of the market to more cyclical and value areas of the market. And so, we're looking at...
Give me some examples.
So you look at the industrial sector, it fell 10% in December.
Right.
I think in the industrial sector, you're going to see, if you see less of a regulatory burden, some of these big projects, you see onshoring to the U.S., you're going to see these industrial companies benefit from that. The higher interest rates that we've seen in December were a factor behind that 10% decline. But longer term, we think the industrial sector will do well going forward.
Anything you wouldn't touch right now?
Anything we wouldn't touch.
Right.
I think energy is a tough sector. The economy's doing really well, and oil has rallied a little bit here, but it's still well off its highs. You look back to the first Trump administration, it was the worst performing sector, even though he was one of the friendliest presidents to the sector, because drill, baby, drill, that's going to mean a lot more oil on the market.
Paul, thank you for coming in this morning. It's great
All right,
to see
thanks
you.
for having me.
Really appreciate it. Thank you.
Thanks.